Away from all of these earnings, we also got a pretty big macro report on both sides of the border, Canada and U.S. jobs. As I mentioned, Canada delivered a jobs report that was kind of negative on two fronts. One, we unexpectedly lost jobs in the month of July. Economists were forecasting a gain, but wage growth actually picked up. This is seen as a problem for central bankers because at 5% wage growth, that's seen as inconsistent with getting inflation back down to target. Let's bring in Beata Caranci. She's chief economist at TD and get some perspective. It's certainly hard to come away with some definitive takeaways, right? What this means for the Bank of Canada. How are you thinking about this report?
Well, I think the first thing is to remember the context. And unfortunately, when it comes to Canadian job numbers, they embedded a significant amount of volatility from month to month. So it's always best to kind of pull that lens out and say, what are we seeing on a trend basis? Because the Bank of Canada doesn't focus on a single month of data. They're looking for like a 3 or 6 month trend. And on that basis, we're still seeing about 12,000 jobs on average on a 3-month basis. To your point, we are seeing a rising unemployment rate, and this is almost like a juxtaposition, but makes total sense because basically it's saying the labor force is rising at a faster rate than Canadian companies can pump out on the job side. With this particular report in July, speaking to the volatility of its nature, there were 6,000 job losses, but I think it was over 40,000 in construction, and that makes no sense for an industry that is, crying about the amount of shortages of labor that's happening in that industry. In addition to just 2 days ago, the government announcing a fast track on immigration for people in the trade sector. So right away, it sends up the alarm bells, like what's happening? And when you look at it on a provincial basis, there is a high distribution of construction job losses happening in British Columbia. And that might actually be related to a single project, LNG Canada, starting to wind down or coming off the peak levels of construction. So there could be quite a bit of anomaly happening in here that are unique to certain industries, not representative of what's happening across the country.
Okay, so be that as it may,
industries.
Sorry to interrupt, but be that as it may, there are not a lot of nuances, as you mentioned, but the Bank of Canada still has a decision to make in September. They have to take this data and the trend. How does that affect their decision?
So I think they have sufficient reason to not hike and stay on the sidelines because that unemployment rate has risen about 50 basis points in a fairly short period, about 3 months. So from 5 to 5.5%. That is probably if I'm going to put some emphasis on the data, that would be where I would place it. To your earlier point that wages are rising at 5%, they will not like that. That is not consistent with inflation being sustained at 2%. Typically, you need wage growth at around 3%. So that's going to have to cool down quite a bit from where we are. But it also happens to be one of the most lagging indicators. So they may not put as much emphasis there.
We also got we've been tracking news of kind of strike actions. Most of the issues at the forefront are wages, wanting wages to increase. That is probably something messy for the statisticians to deal with. But as you look at that trend, more and more job action, how do you expect that to affect where things are going in the job picture?
So the job action is happening obviously in unionized sectors. And these sectors tend to lag the private sector. So effectively what we're seeing is when you look at union wages relative to private sector wages, they have been lagging. Private sector wages had a faster adjustment when inflation increased, whereas because unions are subject to contracts and when those contracts expire is when they move towards negotiations, you get longer lags. So it's not unusual at this point in the cycle that this is that group of individuals who are now fighting for those wage increases. It doesn't necessarily mean it's going to translate into a new round of wage negotiations across the country that leads to wage push inflation. And in fact, typically when you're at this stage of unionized wage negotiations, it's often a signal that you're nearing the end of a business cycle. It's a very late stage business cycle dynamic that takes place. In other words, that we're probably, past peak growth and we're moving into that slow growth momentum and potentially a recession for next year. But that's typically the signals that you start to get when you're at this stage on the wage side.